Welcome to our educational video series. Before you invest in bonds, we encourage you to watch this video till end. It will enable you to take informed decisions. Bonds investing is considered as a safe and fixed income investment. Theoretically, bonds and equity has no correlation and works in opposite directions from each other. Let's see what bond is. Bond is an agreement between a borrower and a lender where a loan made by an investor to a borrower, typically corporate or government. In simple words, government or corporate issue bonds to raise money. In return, issuer promise us to pay interest. In finance parlance, a bond is considered as a fixed income security, as it promises to pay fixed rate interest until maturity. How it works. When organizations need to raise money, they may issue bonds directly to investors. The interest payment, the coupon, is part of the return that bondholders earn for loaning their funds to the issuer. The initial price of most bonds is typically set at par or RS, 1,000 face value per individual bond. The actual market price of a bond depends on a number of factors: the credit quality of the issuer, the length of time until expiration, and the coupon rate. Most bonds can be sold by the initial bondholder to other investors after they have been issued. In other words, a bond investor does not have to hold a bond all the way through to its maturity date. Now let's discuss the relationship between interest rate and bond price. Bonds and bond portfolios will rise or fall in value as interest rates change. Bonds have an inverse relationship to interest rates. When the cost of borrowing money rises when interest rates rise, bond prices usually fall and vice versa. Most bonds pay a fixed interest rate that becomes more attractive if interest rates fall, driving up demand and the price of the bond. Conversely, if interest rates rise, investors will no longer prefer the lower fixed interest rate paid by a bond, resulting in a decline in its price. Let us have a look at bonds' characteristics. Common terminology used in bond investing. 1. Coupon rate. Rate of interest the bond issuer will pay on agreed intervals on the face value of the bond. 6% coupon rate would mean 6% interest will be paid to the bondholder on the bond's face value at end of the year. 2. Maturity date. Date on which the bond will mature and issuer will pay the bondholder the face value principal of the bond. 3. Coupon date. Date on which the bond issuer will pay the interest. 4. Face value, also known as par value, is the amount the bond will be worth at maturity. Interest is determined on the face value. Let's understand this. Bonds with poor credit rating leads to high default risk, and these bonds pay more interest. Bonds with a long maturity usually pay higher interest rate. As we know, bond investing is a confusing affair. One must understand the types of bonds are available in Indian market for investment. Let's see the types available. 1. Government bonds, issued by central or state government, are considered as safest bonds with sovereign guarantee. Typical credit ratings are AAA. 2. Corporate bonds, issued by private and public companies, offers higher returns with the risk of default, includes debentures and NCD, ratings AAA to D. 3. Financial institution bonds, issued by banks NBFCs, offer moderate risk and stable return, ratings AAA to BBB. 4. Tax-saving bonds, issued by government-backed entities, exempt from income tax, comes with a long maturity, ratings AAA to AA+. AAA ratings bonds are considered to be the safest, followed by AA, A and B till D. Any ratings below A is considered risky. Now see the pros and cons of bond investing. Advantages. Regular stream of income. Interest-paying bonds provide a fixed income stream. Inflation adjustment. Inflation-indexed bonds are adjusted against the persisting inflation. Capital invested is also adjusted against the inflation. Thus, it provides an avenue for capital preservation and safety. Sovereign guarantee. Government bonds enjoy a premium status with respect to the stability and a promise of assured return for the investors. Disadvantages. 1. Relatively low return investment when compared with other investment products. 2. Accept few government bonds. Many other categories of bonds do come with a default risk which leads to capital erosion. Now is the time to summarize what we discussed so far. 1. Bond interest coupon and interest rate has inverse relationship. 2. Bond coupon rate is a factor of its credit ratings and time to maturity. 3. Theoretically, bond is a fixed income investment, however not all bonds are risk-free and return is not fixed in nature. Though there are various advantages of investment in bonds, it affects your overall portfolio return due to lower return than inflation in most cases. 4. Bond is a useful investment option to diversify your overall portfolio risk. One must invest certain percentage of capital into bonds for stability of income. With that, I hope I was able to cover important features of bonds and will be helpful for our fellow investors in making decisions.